What if the most confident man in Bitcoin just made his boldest call? Because right now, Michael Saylor, the person who has bet more institutional capital on Bitcoin than almost anyone alive, has said it publicly and without hesitation. Bitcoin winter is over. Not slowing down, not transitioning. Over. And the moment those words hit the internet, something interesting happened. Some people cheered, some people bought. And a very specific group of analysts, people who study market cycles for a living, went quiet for a second, and then started pushing back hard. So here's the question that actually matters. Is Saylor seeing something the rest of the market is missing? Or is he the most dangerous kind of wrong? The kind that sounds completely right? Stay with me. Because what I'm about to walk you through isn't just a Bitcoin debate. It's a map of exactly where we are, what's shifting underneath the market, and why your positioning right now might be built for the wrong version of what's coming. Quick note before we go deep. Nothing in this video is financial advice. This is analysis, context, and perspective. Do your own research. Make your own decisions. Let's start here, because this is important. Like when most people say Bitcoin winter is over, it's noise. When Michael Saylor says it, the game changes. And I don't mean that as a compliment or a criticism. I mean it structurally. Strategy, the company formerly known as MicroStrategy, is sitting on a Bitcoin position that, as of late April 2026, represents one of the largest single corporate accumulations of Bitcoin in history. We're talking about a company that has systematically converted its treasury, raised debt, issued equity, and redirected capital, all to acquire and hold Bitcoin. That's not a trade, that's a conviction. And when the architect of that conviction steps forward and declares that the longest, most painful phase of the Bitcoin cycle is behind us, institutions pay attention, capital flows shift, narratives get written. Here's the part most people miss when they dismiss Saylor. He's not just a commentator with a hot take, he's a signal. When institutional players are trying to gauge sentiment at the top of the capital stack, they watch what the boldest actors are doing. And Saylor has spent years being the canary in the coal mine, except the coal mine, in his version of reality, is full of gold. So whether you agree with him or not, you need to understand his thesis completely. Because it's influencing the behavior of people managing real money. Right now, morning, afternoon, or night. For you right now, drop it in the comments. I want to know where in the world the wealth continuum is reaching today. Now here's where things start to get complicated. To understand what Saylor is actually saying, you have to step inside his framework for a moment. And his framework is built on one central premise. Bitcoin is no longer a retail-driven asset. That phase, the phase where cycles were powered by individual investors chasing price, panicking at drops, flooding social media during bull runs, and disappearing during winters, that phase, in his view, is structurally over. Here's why he believes that. The spot Bitcoin ETF approvals that came through in early 2024 changed the architecture of Bitcoin demand. For the first time, institutional capital could enter Bitcoin through a regulated, familiar vehicle. Not through crypto exchanges, not through self-custody arrangements that make compliance teams nervous, through an ETF, the same way they buy exposure to gold, oil, or the S&P 500. And what happened after that approval? Billions of dollars moved, fast. The pace of institutional inflows into spot Bitcoin ETFs throughout 2024 and into 2025 create a new layer of demand that didn't exist in previous cycles. This isn't speculative retail money chasing green candles. This is allocations, mandates, quarterly rebalancing decisions made in boardrooms. Saylor's second argument is supply compression. The April 2024 halving cut the daily issuance of new Bitcoin in half. Miners now produce fewer coins per block. And the long-term holder data, the percentage of Bitcoin that hasn't moved in a year or more, has been persistently high. A significant portion of the supply is simply not available to the market. When you combine rising institutional demand with shrinking available supply, you get a structural imbalance. And Saylor's conclusion from all of this? When demand is institutional and supply is constrained, the cyclical bottoms get absorbed. Winter doesn't arrive the way it used to, because the buyers who would normally sell into fear are now institutions, and institutions don't panic the same way retail does. Hit like right now if this logic is starting to make sense, even if you're not fully convinced yet. Because here's the thing, it's a compelling argument. It's internally consistent, and parts of it are genuinely backed by data. But there's something else happening, something that Saylor's framework doesn't fully account for. And this is exactly why this matters right now. I want to plant something in your mind before we move forward. Ask yourself this: if institutions really are in control now, if they're absorbing every dip, every panic, every macro shock, then who's left to create the kind of correction that wipes out over-leveraged positions and resets the cycle? Hold that question. Because the answer to it completely changes how you should be thinking about your positioning right now. We'll come back to it. But first, let's talk about the analysts who looked at Saylor's thesis and said, not so fast. Not everyone agrees with Michael Saylor. And the disagreement isn't coming from random Twitter accounts with Bitcoin bear logos. It's coming from serious analysts who have been studying this market for years. Let's go through each one. Mati Greenspan, the macro reality check. Mati Greenspan is a macro-focused analyst who has consistently argued that Bitcoin does not exist in a vacuum. And his core point is simple but uncomfortable. Bitcoin is a risk asset, full stop. When global liquidity is expanding, when central banks are easing, when credit is flowing freely, when investors are moving out on the risk curve, Bitcoin benefits, it rises, it attracts capital. But when liquidity contracts, when rates stay elevated, when credit tightens, when institutions reduce their risk exposure, Bitcoin gets sold not because people hate Bitcoin, because it's on the list of things you sell when you need to de-risk. And here's where Greenspan's argument cuts through. As of April 2026, we are not in a confirmed global easing cycle. Interest rates in major economies remain at levels that would have been considered restrictive by the standards of 2020 or 2021. Credit conditions are not as loose as the bull case requires. The Federal Reserve has been cautious. The European Central Bank has moved carefully. Global liquidity, while not in crisis mode, is not flooding markets the way it did during the 2020 to 2021 period that powered the last major Bitcoin bull run. From Greenspan's perspective, the thesis, winter is over, requires macro cooperation, and macro isn't fully cooperating yet. His punchline is sharp. Bitcoin hasn't escaped macro, it's just temporarily decoupled from it. And temporary decoupling ends. Comment below if you're watching macro conditions right now, or if you're purely focused on Bitcoin native signals. I'm genuinely curious which camp most of this audience falls into. Jason Fernandes, the cycle argument. Then you have Jason Fernandes, who comes at this from a different direction. His argument is rooted in market psychology and cycle theory. Every major financial market moves through predictable phases: accumulation, expansion, distribution, contraction. These aren't arbitrary patterns. They're the behavioral footprint of how humans process greed and fear at scale. And his concern with Saylor's "winter is over" declaration is specific. When a prominent, credible voice announces the end of a cycle phase, especially during a period of partial recovery, it creates a dangerous dynamic. Retail investors hear winter is over and interpret it as a green light. They reduce their caution. They increase their position sizes. They stop waiting for better entries. And what happens when enough people do that? The market becomes crowded at exactly the wrong level. Fernandes's view is that the cycle hasn't been abolished. It's been stretched. The accumulation phase may be longer. The distribution phase may look different. But the fundamental dynamic, hype, overextension, correction, reset, that dynamic doesn't disappear because institutions entered the market. Institutions can be wrong too. Institutions have cycles of their own. Budgetary cycles, risk appetite cycles, regulatory environment cycles. His point lands hard. Calling the end of winter too early doesn't just make you wrong. It makes the people listening to you wrong at exactly the moment they can least afford to be. Now here's the part nobody is paying attention to. Benjamin Cowen, the data-driven perspective. Benjamin Cowen adds a layer that I think is the most analytically sophisticated of the three. Cowen's work is focused on quantitative cycle analysis, not just identifying cycles, but measuring their evolution over time. And his observation is this: Bitcoin cycles are real. They exist, but they are not static. Each cycle is structurally different from the last. The timelines stretch. The amplitude changes. The indicators that worked perfectly in 2017 do not work the same way in 2024 or 2025. His concern with declarations like Saylor's isn't that they're entirely wrong. It's that they're applying a binary framework, winter or not winter, to a market that has become significantly more complex. Cowen's data suggests that sideways movements, delayed corrections, and extended consolidation phases are increasingly part of the Bitcoin cycle structure, which means the market can be in a technically bullish long-term trajectory while still delivering painful medium-term corrections. He also flags something important about on-chain data. Even with institutional flows, certain on-chain metrics that have historically preceded corrections, metrics related to profit-taking, supply distribution, and exchange inflows from large wallets, have shown patterns that warrant caution. His position isn't bearish, it's precise. Risk doesn't disappear in a bull market. It just disguises itself, and that disguise is exactly what makes it dangerous. So now you have two completely different ways of looking at the same market. Saylor's world is structural, institutional, post-cycle. In his framework, the old rules are being rewritten by the weight of capital flowing into a finite asset. The analyst's world is contextual, cyclical, risk-aware. In their framework, Bitcoin has evolved, but it hasn't transcended the forces that drive all financial markets. Same asset, same price, completely different conclusions. And here's what's interesting about that. Both sides have data, both sides have logic, both sides have track records. Which means the question isn't who's smarter, The question is, which framework more accurately maps what's actually happening right now? Are you positioned for Saylor's world, or the analyst's world, or neither? Drop it in the comments. I genuinely want to know. Here's where I want to zoom out. Because I think both sides of this debate, as smart as they are partially missing something that's happening at a level deeper than price cycles or macro conditions. Bitcoin is undergoing a control transition. For the first 12 to 15 years of its existence, Bitcoin was primarily owned, traded, and driven by a specific type of participant. Early adopters, tech idealists, retail speculators, people who found Bitcoin through forums, podcasts, YouTube channels, and crypto Twitter, people who had strong opinions, volatile emotions, and relatively small individual positions. That cohort, call them the native Bitcoin community, they shaped the market's behavior. Their sentiment was the market's sentiment. When they were euphoric, prices spiked. When they were fearful, prices crashed. But something has been shifting since 2023, and it accelerated dramatically through 2024 and into 2025. The ownership composition of Bitcoin is changing. Large institutional holders, corporations, ETFs, asset managers, sovereign wealth funds exploring the asset class are now holding an increasing percentage of the total circulating supply. And here's why that matters more than most people realize. The behavioral profile of these holders is completely different from retail. Institutions don't panic on a Tuesday morning because a macro influencer posted a scary thread. They don't move because Bitcoin is trending on social media. They move based on mandated rebalancing schedules, risk committee approvals, and quarterly allocation reviews. This changes the character of the market, not just the price level, the character. What we are potentially witnessing is a slow-motion transfer of price-setting power from the vocal, emotional, reactive retail community to the slower, more deliberate, but ultimately more powerful institutional community. And this is where it gets really interesting. What happens next is the real story. Remember, at the start of this video, I planted a question. If institutions are absorbing every dip, who's left to create the kind of correction that resets the cycle? Here's the answer. Nobody obvious. And that's exactly what makes this moment so unusual. In previous cycles, the reset was driven by retail capitulation, mass panic, everyone selling at once, exchanges getting overwhelmed, the kind of market bloodbath that shows up on every crypto Twitter timeline simultaneously. That kind of reset is structurally harder to trigger when a significant portion of the supply is held by entities that don't have access to panic buttons. But, and this is the critical but, there are still scenarios that force institutional selling. Regulatory shocks, macro credit events, forced liquidations from leveraged institutional positions, geopolitical disruptions, a failure of a major financial intermediary that holds Bitcoin on behalf of clients. These aren't base cases, but they're not science fiction either. So here's what Saylor's thesis is really saying. Stripped of the confident language, the floor has been raised. The worst case scenario may be less severe than it used to be, and the path back to full contraction may be longer and harder for the market to achieve. He may be right about all of that, but less severe doesn't mean zero. Shorter winters are still winters, and that reframing, right there, is where the real intellectual honesty of this debate lives. Subscribe to the Wealth Continuum right now if you want to stay ahead of conversations like this one. This is the kind of analysis that doesn't make it into mainstream financial media, and it's exactly what you need before the next phase unfolds. So what actually happens from here? Let's map it honestly. Scenario 1, Saylor is right. Institutional accumulation continues. ETF inflows stay consistent. The halving-induced supply compression tightens the market further. Long-term holders continue not selling. In this scenario, any dips are absorbed quickly. The pattern of higher lows gets reinforced. Bitcoin makes new all-time highs within the next 12 to 18 months. The people who called for caution miss significant upside. In this world, calling this a bull market early was correct. And Saylor's legacy as the person who understood the new structure before anyone else gets cemented. Scenario 2. The analysts are right. Macro conditions tighten. A credit event or liquidity shock ripples through global markets. Institutional players reduce risk exposure across all assets, including Bitcoin. The retail community, which was reassured by winter is over messaging, gets caught overextended. Leveraged positions get liquidated. Price drops sharply enough to shake confidence in the institutions always buy the dip narrative. In this scenario, the bull declaration aged poorly, and the people who maintained healthy skepticism were rewarded for it. Scenario 3, and this is the one I think deserves the most attention. Both are right simultaneously, not in contradiction, in parallel. The upside is being driven by institutional accumulation. The downside risk is still being controlled by macro forces, which means you have two competing engines running at the same time. One pulling Bitcoin higher on a structural long-term trend, one capable of delivering sharp, painful, shorter corrections when macro conditions deteriorate. if scenario 3 is the actual reality, then the market is not simpler than before. It's more complex, more layered, and frankly, more dangerous for people who are operating with a single simple thesis, whether that thesis is full bull or full bear. The person who says winter is over, buy everything, is at risk. The person who says cycle still applies, nothing has changed, is also at risk. The person who holds both realities in their head simultaneously, who understands the structural tailwinds and respects the macro risks, that person is positioned for the actual market that exists, not a comfortable version of it, the real one. What would you do if scenario 3 is actually playing out right now? Think about it genuinely, because the answer to that question tells you more about your portfolio construction than any single price prediction ever could. Let's bring this all the way down to what it actually means for you, because this is where most finance content loses the thread. It's easy to analyze Saylor. It's easy to analyze cycle theory. It's harder, and more important, to translate all of this into a framework you can actually use. Here's what I want you to take away. Blind bullishness is a positioning error right now. If you're carrying high leverage, if you're ignoring macro signals entirely, if you're treating winter is over as permission to turn off your risk management, you're not positioned for this market. You're positioned for a simplified, idealized version of this market. And those two things are very different. But here's the flip side. Excess fear is also a positioning error. If you're sitting on the sidelines entirely waiting for some perfect confirmation that winter is definitively over, you may be using the language of prudence to avoid making decisions. And meanwhile, the structural shift that Saylor is describing, the institutional accumulation, the supply compression, the changing ownership profile, that shift continues whether you're participating or not. The real risk isn't picking the wrong price level. The real risk is being built for the wrong version of the market. Think about it this way. If you built your entire strategy assuming volatile retail-driven cycles, massive crashes followed by explosive recoveries, and the actual market from here is slower, more institutional, with shorter but sharper corrections rather than deep, prolonged winters, you might be waiting for entries that never come in the old form. Conversely, if you built your strategy assuming institutional demand permanently eliminates serious downside risk and macro tightens and forces a significant correction, you know where that goes. The answer isn't picking a side and committing to it emotionally. The answer is building a framework that remains functional across multiple scenarios. Are you positioned or just watching? And more importantly, positioned for which version of what's coming? Share this video with someone in your network who is actively trying to figure out their Bitcoin positioning right now. Not someone who needs convincing that Bitcoin matters, someone who is past that conversation and is genuinely trying to understand where we actually are in the cycle. This is the conversation they need to hear before it's too late to act on it. So let's come back to the question we started with. Is Bitcoin winter really over? And I want to give you an honest answer. Maybe. Maybe the structural shift is real enough and the institutional demand is deep enough that the kind of prolonged, gut-wrenching, market-wide crypto winter we saw in 2022 is structurally harder to reproduce. Maybe Saylor is right that this is a new era. But here's the more nuanced version of that truth. Winter hasn't disappeared. It's just changed its shape. It's shorter. It's faster. It's masked by institutional buying that creates false floors. And when it does hit, when macro forces or a credit event or a regulatory shock overrides the institutional thesis temporarily, it can still hurt. We might not be entering a prolonged winter, but we might be entering a new kind of winter, one that looks like spring until it doesn't. And the people who are prepared for that version are the ones who will be standing after it passes. Comment right now. Bull, if you're with Saylor, you believe the structure has changed and the winter playbook no longer applies. Cycle, if you're with the analysts. You believe the cycle is real, the macro matters, and caution is warranted. Or both, if you're holding the complexity. You see the structural tailwinds and you still respect the downside scenarios. I want to see where this community actually stands. Here's the final thought I want to leave you with. The next phase of Bitcoin is not going to be decided by opinions. Not Saylor's, not Greenspan's, not Cowen's, not mine. It's going to be decided by who controls the supply. And that battle, the slow, grinding, relentless battle between institutional accumulators and macro-driven forced sellers, has already started. It's happening right now, in the order books, in the quarterly reports, in the quiet decisions being made by risk committees and offices most of us will never see the inside of. The question isn't whether you believe in Bitcoin. The question is whether you understand the game that's actually being played around it. If you want to stay ahead of that game, subscribe to the Wealth Continuum, not because I have all the answers, but because this is the space where we ask the right questions, build the right frameworks, and refuse to pretend that any of this is simple. Because it isn't. And the people who treat it like it is are going to learn that the hard way. Stay sharp, stay positioned, and I'll see you in the next one.